G'day guys, Josh here. Welcome to Financial Fruits Part 5, and that's going to be equity. So basically we're focusing on the asset classes at the moment. So you guys are familiar with the asset classes and basically know what they are. So last episode we talked about property. Okay, so let's link in property to the next one. Okay, so for property, you can actually buy property as an equity because most of the property companies have listed themselves on the stock exchange. So you can buy a piece of, let's just say, Lend-Lease, or Lend-Lease, which is a property operator, Stocklands in Australia. I mean, you think of a property company in your own area where they develop property, stuff like that. You can find them on your own stock exchange. Not many of them are privately owned. So, what is equity? So equities are normally known as shares, share trading, share exchange, stuff like that. So basically they're on a share market. You can see the ticker, let's say for Rio Tinto, Rio is generally Rio. And you can see, buy, say $32 to buy a Rio share, and then it says sell for $33, which means in the stock market itself, it means that, the highest buy is $32 and the lowest sell is $33. And if they come together, then the share is bought and sold. So a share is sold on an exchange, and generally the settlement period in Australia, so we use Australia as the domestic equities example, is T+2, which is basically in 2 days, you have to have the money, okay? The money and shares will exchange. So now what is a share or a stock? That is the main question. So a stock is a part ownership, so that's what equity is. A ownership stake in a company. Okay, so if you own one share and there is 1,000 shares, you own 1,000 of the share. Okay, so if you get that one right. And why are stocks a good investment assets? Well, from a stock you can get paid. Your stock can appreciate if it goes well, business booms. Yep. Or receive dividends, i.e. income. So there's two things that your stock can appreciate. It can appreciate via capital, so it's getting bigger. So basically your share price goes up because they're recognizing the higher value of the company on paper or in their minds as well. Or you get paid dividends where the share owner's like, oh, we can't do much with this cash. We'll just pay it out amongst their shareholders and keep some of it for ourselves. So for dividend shares, generally, if they pay high dividends, it usually means that they've grown to their maximum capacity as they're not reinvesting themselves. Generally with shares that are, basically still got more room to grow, they'll pay a small dividend, but keep most of it internal as well. So basically, dividends decrease the share price, okay? So basically, if you pay a dividend, the share price goes down because you're paying some of your equity out to your shareholders. Now, so with a share, you know that it's a part ownership in a company. So if you have one share in 1,000 share companies, you own 1,000 share of the company. You can share the profits as well. You basically share on the profits via dividends generally. So the company makes an announcement to pay out dividends as well. There are multiple other corporate actions that we'll probably discuss in a later chapter. I don't want to discuss it here, like buyback, share purchase plans, renounceable rights issues, and stuff like that, and options. But I don't want to talk about it here. Let's talk about shares. So with the share market, so what you want to do as yourself, you want to take a look at your domestic share market. And for the purposes of this video, we're going to use the Australian share market. So let's just delete these quickly as well, because we've learned just a quick gloss over. So in the Australian share market, there mainly are banking shares, resources shares, investment banking as well, and telecommunications in the top 20. So generally what you want to know is that with your stock exchange, other than the US stock exchange, generally the top 20 shares make up a large majority of your overall index. So basically overall, Australia only has exposure to mainly banks and shares. Or banks and resources, sorry, not banks and shares. So if you want to invest in something like tech stocks, healthcare, anything that isn't that, like, IT, I don't know, like, there's a lot of areas, infrastructure, international property. If you want to invest in those sort of, areas, you are out of luck here. Okay, you can't invest in those anywhere. You can't invest in those here unless you go overseas and invest in the international share market. So you can see with the domestic share market, it's very restricted and concentrated on a certain amount of areas. Okay, so there's a few healthcare shares in Australia as well, which is mainly CSL, Sonic, Cochlear. You guys may know these as well, because you may have seen them as well. Ansell, who make rubber gloves. But you can see here that there's not very many compared to America, for example, where you can just find all of them on the NASDAQ. Now let's talk about the tech stocks as well. Like, there's no Google, Apple, Samsung, Netflix. All those jazz are all overseas, okay? So there's not many of that here as well. So you can see the weaknesses in investing in this Australian share market is that realistically, all your exposure is going to be mostly banking, resources, and stuff like that as well. But main reason why it's less riskier is because you know the brands, you probably be more hands-on in the business, or probably know the business, through subsidiaries or anything like that. So you can keep a really monitor on the business. Overall, shares are quite risky because you are basically subject to if the business lives or dies. Generally, if you invest in the top 20 or top blue chip shares, most of those businesses they are mature and have some sort of leverage or advantage in the market or over the other competitors, and it's going to be very, very unlikely that they're going to fall over. Now, with the share market as well, as I said before, you can own property and stuff like that as well. In the share market, you can own a thing called an ETF or a LIC. And you may be like, what are these? ETF stands for Exchange Traded Fund or Listed Investment Company. So this is another type of share. So with this type of share as well, it's basically investing in a pool of assets managed by a fund manager who invests into the market for you. Now you'd be like going, why would I need a fund manager? Well, if you want to replicate the ASX 200 and you want to replicate it without incurring a lot of brokerage, you would need, let's just say maybe $500,000. Okay, that's just a very, very low ball. Okay, to replicate the ASX 200, or you can invest your $5,000 in an ETF, pay a percentage fee, because generally they charge, let's just say for Vanguard, they charge about 0.18% on the return, and you get that diversification for that much. And that's why people use exchange traded fund and listed investment companies for that. Now LIC is different. LIC is more active. So what they will do, they'll chase and they'll buy, sell shares, buy low, sell high, and we'll get a absolute return. ETFs, exchange traded funds, are generally just index chasers, okay? So it will follow the index always. So I've talked about the types of shares. We've talked about, other shares on the market. There are another types of shares called CDIs, okay? They are called, the deposit interests, okay? Now, what they are is that generally what happens when international shares are bought by Australian companies or demerged or anything like that, but they don't have a listing on that stock exchange, they're called deposit interests instead, or CDIs. So what happens is that, let's say for use of recent examples, that BHP paid Woodside shares as a dividend, okay? Now with Woodside is only listed in Australia. So for all the other companies, for all the other countries that BHP is listed in, which is America and London, they received Woodside CDIs in London and the US. So what this means is that the CDI generally will have a ratio of how much shares you own in that local stock exchange. So basically, if you have a share, let's say CDI is 8 Woodside shares, so it's basically 8 for 1. So you may see this, listen to shares, but if you see 8 for 1, it means that for every interest you have, you own 8 Woodside shares. So if you follow me here, that you own 8 Woodside shares for every compulsory depository interest that you have. So you receive the income from it as well. Now, if Woodside decides to list in Australia or list in America, you get 8 shares. That's pretty much it, okay? You get 8 shares from it. But that's what the deposit interests are, is the disbursement of shares that aren't listed in your company. And that the company that's giving it to you can't pay you a cash amount in exchange. So it's an easier way for a company to sell off its interest in other areas. So as you can see here, like, Woodside shares, a lot of people have deposit interests. These interests obviously can vote as well, but you probably wouldn't want to. And that's, I guess say right now, that's pretty much shares in a nutshell, okay? Like all the different types of shares that you can have. Now, you can also have some hybrids as shares as well. You can also own properties with it as well. Um, that is the domestic share market overall. And that's, quick ramble of all the shares in the domestic share market. I just realized I've been talking about this for 10 minutes. Now, let's just finish off with the international share market, okay? So the international share market, we're going to use America as an example, okay? In America, so let's just compare to Australia. So Australia was all resources and banks. In America, you can get resources and banks too. But the big exposure it has is to healthcare. Some oil companies as well. Tech, especially tech. And in Australia, we don't have that. So if you want to get exposure to both healthcare, oil, technology, and oil, you have to invest in the US. And people generally do this via ETFs and LICs. So with the fund managers as well, they also can pull funds together to invest internationally. Also, as well, you're going to put down here logistics. Everyone receives their stuff via Toll, Amazon, and stuff like that. Those companies don't exist here anymore. They're not listed here. They've been taken over and taken private. So you got those guys as well. And also you got, farming businesses as well. Not many of them in Australia. Mainly all, smaller stuff like that. In America, you can own a piece, they're listed on the stock exchange. You even got General Electric, infrastructure stock as well. A lot of the companies, a lot of big companies that you use for your consumables, even PCs and stuff like that, are all based in the NASDAQ or based in the Dow Jones and stuff like that, that you need some sort of exposure to, basically. And that's why international shares are very king as well, because you go to Japan, for example, you go to China, you go to various other countries that have different tech stocks that you use, like gaming companies as well, like, Blizzard, let's just go for, gaming companies, they're all in the US or Japan or other stock exchanges that you can't get access to unless you in an ETF overall. And that's how you really access international shares. Now, the reason why international shares are more risky is that there's a thing called currency risk, okay? So the reason why international shares are so risky is that the currency, FOREX as people call it, basically the Australian dollar can appreciate or depreciate, or vice versa, the other dollar getting stronger. So if the Australian dollar goes down and you're trying to buy a US share, that price increases because you pay more Australian dollars to get that share. But if it goes the other way around, where the Australian dollar appreciates against that currency, you just need to spend less to get that share. So basically, if the Australian dollar, so if you're buying, Australian dollar appreciating is good, but if you are selling, Australian appreciating is good, and Australian dollar depreciating is bad. And the main reason for it is that you need more money, or you need more AUD to purchase the same amount in USD if the dollar depreciates, okay? And on the flip side, you need less if your dollar appreciates, okay? Now, the other end is obviously selling. It's vice versa. So, Australian dollar depreciating is good, and Australian dollar depreciating is bad. Appreciating is bad, because you get less of it. Anyway, that's pretty much it, because once you're in US dollars and you sell to Australian dollars, you get less, basically, okay? Compared to, buying 50 cents of it. Now, the main thing what's going to happen to Australian dollar? Australian dollar is always is quite low. It hangs around 0.60, 0.08 to USD. The reason for that is that Australian companies get rich because we're mainly export based. We import a lot, but export minerals such as iron. And all iron, oil, etc. are denominated in USD, okay? So therefore, AU dollar being low equal good for us. Okay, that's for the Australian market. Okay, I don't know about your economies overall, but that's, you know, basically currency risk in a nutshell. Okay, so basically, if you're selling goods, the Australian dollar being down is good. So you can see here, even though I've spelled depreciating completely and utterly wrong, let's just spell it right, okay, so you guys won't be a bit crazy. So you can see here that, you know, for the miners companies and oil companies, Australian dollar depreciating is good. Australian dollar appreciating is bad for them. Okay, they don't want that to happen. They want it to get lower, so when they sell the iron ore in USD and convert it back to Australian, they get more money. Okay, so they can pay all the people in AUD, like, as well as they pay their, you know, employees in Australian dollars. They don't want it going up, because if they have it going up, they get less money to pay people. They want it going down, so they get more Australian dollars and more Australian dollars to pay people. And that's basically currency risk. Now, a lot of people do promote Forex trading and stuff like that. Let's go talk to Forex trading here as well. They do promote Forex trading. Forex trading is incredibly risky, okay? It is more riskier than share trading, okay? So be aware of that. More risky than share trading. So just touching on Forex here, more risky than share trading. Don't do it, okay? Don't do it if you have no experience in trading, because you are going to get burned so much. Like, so much. But anyways, guys, that's pretty much it for shares for today. So shares is their domestic shares is basically your own market. Your own market mainly having a few exposures to more industry areas. It is the international share market, which is a bit riskier due to currency risk and not knowing the market, but it provides you immense diversification to other areas. I mean, look at the comparison here between Australia. I'll just put that in there. Between the US and Australia. So you see Australia here, not much industry sectors, but in America, you can get access to so many different fields and so much diversification that you may be able to use those cycles to your benefit, where like resources and banks are in a bad performance, but since healthcare and all this performed well, your shares are even or up. Anyways, guys, that's going to be it for Financial Fruits today. Hope you enjoyed the series. Like, comment, subscribe. We'll probably be talking about, we're getting out of the asset classes and probably talking more about investing and other areas a bit later. Anyways, guys, hope you guys have a great day. Like, comment, subscribe. See you guys later. Peace out. Bye.